Yeah, good day and welcome to another session of tutorials with yours truly, Mr. Ebenezer. Please, before we start this lecture, it's important for me to beg you subscribe to this channel if you have not subscribed. Click on that notification button if you have not clicked on it. Watch our videos, help us to help you. The essence of why we are also doing this video is to impart knowledge across board so that we can reach as many as possible to prepare you, not only for you to pass your exam, but to prepare you to become a good chartered accountant. So let's proceed in our lecture today. We're going to be looking at the conceptual framework under the CR and the FRO class. The conceptual framework. When we talk about conceptual framework, it is a policy document, and this was issued by IASB in the year 1989. And then what this conceptual framework is to what it gives is that it gives credence to the prevailing accounting standards that were being utilized in the preparation and presentation of financial reports. So what the constitutional framework is giving is just a policy that spells out in details the lacunas that were observed in terms of definition of certain things, how certain items should have been recognized or operated as it was. So it is one of the policies that really guides and help accountant in the preparation and presentation of a financial report. That is that for that. So under this conceptual framework, it's important for us to know what are its importance as it were. What are its importance? The importance of this conceptual framework. When we talk about the importance, we are talking about the importance of this conceptual framework. So we're talking about the benefits. What has it added to the accounting body as a profession? Number one, it has strengthened the financial report. It has strengthened the financial report as it were. It has strengthened the financial reports. It's just self-explanatory as it were. It's really strengthening it. Before the advent of that policies, all of this one happened before convergence took place, as it were. And so you can hardly see where there are no tendencies of issues there as regards certain things and certain ways by which we operate and prepare the financial report. But with the advent of this conceptual framework, it has really helped conceptual framework. It has really helped financial report to be much more strengthened. And then number two, we have the fact that it has void contradictions and inconsistencies, and the inconsistencies, between standards and legislations, that is laws, between standards and let's just put laws and legislation. So what we are saying is that certain clarity were not given before the conceptual framework, but with the advent of with the conceptual framework, all of these contradictions, inconsistencies, as it were really ward off, and then the quarrel between standard and laws were clarified, and accountants know what to do when they are preparing and setting up a financial report. What other value has this framework added? It has also helped to promote the usability, of the use of applicable standard, the use of applicable accounting standards, as it were, the use of applicable accounting standards. So, we said earlier that it has strengthened the financial report. Then now we are looking at the fact that it has promoted the use of applicable accounting standard. Because of various issues that the foremost standards were bringing, it becomes difficult for accountants or those preparing those financial reports to make the use of those standards adequately and correctly. But with the advent of the conceptual framework, it now gives an overview of what is required, what you need to know, and then that has really enhanced the quality of information that have been provided in the financial statement. It's a policy document that contains about 8 chapters, and when we look at these 8 chapters, we actually understand the kind of value that it has added to accounting profession as it were. And so quickly, let's look at the fourth importance of benefit of value that it has added, and it is that it has really addressed some critical issues not addressed. It has addressed critical issues not addressed by the standards, not addressed by the accounting or by the IFRSs, as it were, by the IFRSs, that is accounting standard. So now, certainly, the standard do not give a definition to certain things. You understand? Certain items of the financial statement. It is the conceptual framework as a policy that now spells in details what an asset, for instance, imply, what a liability, for instance, imply, what is an expense, what are equity, and what are incomes, as it were. So the conceptual framework really addressed certain critical issues that were not addressed by the IFRS. So these are basically the importance of the kind of value that this conceptual framework has added to the operations of our accountants worldwide. So quickly, let's look at, like I said earlier, this is a policy framework and it contains about 8 chapters, which we are going to look at maybe 3 or 4 of the chapters in this video, and then the last 4 in the next video. Please, if you have not subscribed again, I'm begging you, go and subscribe to this channel. If this is your first time of coming across us, please watch our channels and like it, whatever it is that we are doing, and I'm sure that you will enjoy more of us. Please, let's go ahead and so I will not bore you much in this class. So we have looked at the importance now. So what we quickly look at are the 8 chapters, that are in this policy manual. What are the 8 chapters? That's 8 chapters all together. 8 chapters of the conceptual framework. So we have number 1, we have 8 chapters. So instead of listening them, just follow up. We look at the first one, that is the objective of let me just put one here. Objective of the general, that's a general acceptable accounting principle, GAAP financial report. Let's put it this way. It's the same thing. Objective of GAAP financial report. That is, the standard did not tell us what is the objective of availing financial reports, but the conceptual framework tells us what exactly is the objective of availing financial report. And then the objective is this. It is to give the users. It is to give the users. Give the users quality information. Is to give the user quality information for quality decision making. Like I said in one of our previous videos, I said the essence of we even providing or producing financial report is not just to render, stewardship accounts as it were. It is for the decision making of the users. It is for users of this financial report. Accountants are just preparing the account for certainly some users. And so the objective of you preparing your financial report is so that you can give quality information as regards what exactly has transpired within a period, and for those users to make quality decisions. And then you can be asked, who are these users? The users can be classified. The users can be classified into external users and internal users. Please, this is chapter 1 that we are looking at now, internal users. The external users include the investors, the lenders, the suppliers, government MDAs, that is ministry, department, and agencies. And then a lot of them like that. These are all the external users. The banks, all those ones, they are classified as the external users. And all of these users, they also have what we call their users need. Why do they need the financial report? You understand? For instance, the investors, they need to know the viability of the business. And that is where you see them, they go and check what is the financial performance of the business, or what is the financial position of the business. So they need the information on those financial reports to make a good decision. What about the lenders and the suppliers? They need to know the gearing level of the entity. What about the government NDAs? They need to know the level of compliance with payment of tax, pension, contributions, and the like. So all of these are external users. Then we have what we call the internal users. And a good example are the managers of the business. Managers of the business need this financial report to know if they have done well or not. What about the employees? The employees need to know if the organization will continue to be in existence or continue to pay their salaries. Continue to pay what we call their salaries. So it's important for us to look at this from this angle. So these are the first steps of these are the first chapter in this conceptual framework and all that is it entails. So we move to the second chapter, and that talks about the characteristics of the conceptual of characteristics of the financial statements. Characteristics of financial statements. So when we're talking about these characteristics now, let's put it the way they put it in the policy. They call it the qualitative characteristics, meaning that there are other characteristics, but the qualitative characteristics of a financial report. If we agree that the financial report is to give the users information required to make adequate decision, what are the qualitative characteristics, the features that such financial report must present? So we divide these qualitative characteristics into two aspects. We have the fundamental characteristics, and then we have the enhancing characteristics. Now, when we talk about fundamental, it means the most germane, the most important, very, very important. And then when we talk about the enhancing characteristics, we are talking about what gives more credence, what added more value to it. So under this fundamental characteristic, we have the fact that for you to call the financial report of a quality, that it has a quality, that it has given quality information, the fundamental is that the information that is provided must be relevant. Must be relevant for the users. Must be relevant to the users. Very, very important. Number two, the information there must be faithfully represented. Faithful representation of information. That is the number two characteristics. Then we have under the enhancing characteristic, we have it, I call it V-cut. Meaning that for the information that is provided on the financial statement to be referred as being of quality for users, the V-cuts apply. And what is V-cut? V-cut means that it must be verifiable. The information must be verifiable. The C stands for comparability. The information are comparable. You can compare the information of an entity. It gives you the privilege of comparing the information of an entity, maybe entity A, with that of entity B, without any form of ambiguity. Then the U is understandability, meaning the information availed is understandable, because if it is not understandable, there is no way you can make any decision. Then the T is that it must be timely, meaning that that's why we have timeliness. Information you are provided on the financial statement must be timely. You don't need to delay it. Information of 2 years ago may not be adequate to make an informed decision today. Why? Inflation has certain things, occurrences, happenings have happened, have taken place. So therefore, information of the last 2 years may not be very applicable, and for you to make the correct and the right decision as at today. And so these are the enhancing characteristics. So you can be asking your exam. In fact, they used to ask this. If you are going to ask question under this conceptual framework in this, rest assured that this qualitative characteristics of financial in any of the dies, rather not only November, May dies, November dies, in any of the dies, we are rest assured that this characteristics of financial statement, they can ask you, but it's very cheap. You don't need to cram it, just know it. I call this one VCOT, this one is RF. You can even put FR here, Father VCOT. Sorry that I'm using that, FR VCOT or Father VCOT. If you have gotten it, and one thing is we just like to give strategies to how students can pass their exams. The CRFR is a voluminous course, and so you need short course for you to be able to also have the adequacies of the knowledge for you to pass and qualify. So please, let's move ahead. We have looked at the chapter 2 and the chapter 1 and the chapter 2. Let's quickly look at the chapter 3. And the chapter 3 is talking about the elements. The elements of sorry, not the elements now. Chapter 3 is talking about what we call the sorry please, the financial statement itself, and then the reporting sorry please. It's talking about the financial statement and the reporting entity. Chapter 3. Financial statement itself, financial statements, and the reporting entity. The reporting entity. Now, before we go ahead, under the chapter 2 that we just looked at, under that fundamental characteristics, where I talked about the faithful representation of the information must faithfully be represented on the financial statement. There is also what we call substance over form. I'm moving that before we end this video, I'll be able to give you a detailed notes on it. However, if I'm unable to give a detailed notes on it, what we simply mean by substance over form is that information, that is, those items and figures that you are putting in the financial report, must be reported at their commercial substance, at the commercial value, and not necessarily at their legal form. What we are simply saying is that, for instance, now a lease contract between the lessee and the lessor. You understand me now? When we are talking about lease contract under IFRS 16, we will look at it in one of our videos subsequently that will soon drop. Then you can just keep that notification button. That's why you need to keep it in, so that once you drop the video, you can see it. Now, under that lease contract, now the lessor, who is the owner of the asset, the qualifying asset in question, leases it out to the lessee for use. And under this conceptual framework, for instance, when we get to these elements of this the next chapter we are looking at, it defines an asset as an asset to a business, meaning that you own it. And for you to have ownership on the asset, it means that you must have at least 51% control over the assets. Also, but under the lease agreement now, in the eyes of the law, the owner of the property is still the owner. But under accounting principles and accounting standard, as it were, the ownership has already shifted the day that a contract is entered between the lessor and the lessee to transfer the use of that asset for a period of time to the lessee. So that's why we say you carry the asset in the commercial substance, or you carry the asset or items in the financial report in their commercial substance basis, and not at their legal form. and not at their legal form. You will understand it better when we get to the next video. Please, let's quickly go ahead so that we can understand this. Financial statements and the reporting entity. Under this one, we have two: financial statement, reporting entity. Financial statement, they are sets. There are 5 sets as it were. 5 sets as it were. As follows. Number one, we have the statement of financial position. Statement of financial position, which you also know as your balance sheet. That is one. We have statement of P or L, another comprehensive income, which also known as your profit and loss account. And then we have the statement of cash flow. And then we have the next one, statement of changes in equity. Statement of changes in equity. And then we have statement of policy compliance. Statement of policy compliance and adoption and disclosures, which we know as notes to account. So these are the 5 sets of statements that you have in your financial report. When we're talking about financial statement, the whole financial report, these are all that it contains. There is no standard that tells us details of this before the conceptual framework. It was when they now revised IS1 that we have some of these things in IS1. So that is that for that. So when we talk about the reporting entity, who is the one that is to prepare the financial report? It is known as a reporting entity. So reporting entity is an entity that is required to prepare financial report. Simple as ABC. And they can be classified into 3. We have the first one to be known as a single entity, that is a company on its own. Single entity, company standing on its own. And then the next one is a portion of a single entity, which we know as a division. A single entity that is known as a division. Why am I bringing this one in? When we talk about division, for instance, when we get to IFRS 8, IFRS 8 talks about the operating segment. A division, you call a division within an entity a division if they generate their own income and they generate their own expenses, the net of their own expenses. Certain criteria also applies. When we get to IFRS 8, we get the details, we get to know that details effectively. So we have a portion of a single entity known as division, and we have what we call the double. I call it the double, but known as double entity, which was known as group. That is a company and maybe a subsidiary or an associate, or into a joint venture. So when we have this group entity, they are known as a double entity. So that is that for that. Under this financial report, under the reporting entity. So we have what we call also what I will call also the underlying assumptions when preparing and presenting financial report. But let's look at that after we have looked at this chapter 4. So together we look at substance over form. We look at these underlying assumptions in the preparation and presentation of financial statement. So quickly, let's go to chapter 4. And chapter 4 is talking about the elements of financial statement. Elements of the financial statement. Elements of the financial statement. So it's important for us to have understanding of what the elements of financial statements are. Very, 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 very financial report. So very important for us to look at it. But what we do is let's look at this in our next video. I promise you to be a very more enlightening session. And why am I saying this? Because we need to look at it holistically, having the understanding of what the elements of financial statement itself are in the overall. Thank you again for watching this video. Please look forward to the next video. Thank you so very much.